Dividend stocks are getting slammed, and many investors are wondering how to make up for that lost cash flow. In this video, we'll compare dividend stocks versus real estate investment trusts for cash yield and safety. I'll show you why real estate is the best bet right now and how one fund in my portfolio is paying an 8% plus yield. We're talking dividends versus REITs today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, you know I'm a huge fan of dividend investing. That's safety and cash flows and just the market-beating return you usually get from that. So you can imagine the look on my face when I saw this chart showing dividend stocks are getting slammed in this market. That's the S&P 500 market index in green, and that 11% drop year to date doesn't make me feel all warm and fuzzy inside. But look at the spider S&P dividend ETF, the SPYD. That's in red here, and more than a 32% lower drop on the year. Companies are slashing their dividends right and left, from Alliance Data Systems to GM. And since 1926, dividends have accounted for 40% of the total stock market return. And with a lot of people living off their dividend checks here, this is an ugly picture getting even worse each month. So when I saw this, I looked through my portfolio and was actually equally surprised that one investment was still producing an 8% plus dividend yield that's been paying out since inception, a real estate investment trust. So what I want to do with this video is compare those real estate options, the REITs against those dividend stocks. We'll look at how bad dividend cuts might get in stocks, which sectors could be hit the hardest, and how REITs are stacking up. Then we're going to look at that REIT fund that has been able to maintain its high dividend yield even in the worst economy since the Great Depression. And again, it is tough to overstate the importance of dividends for investors. And going back over almost 100 years of market data, those cash flows contribute nearly half the total market return. Now, during the last crisis, companies in the S&P 500 cut their dividends by an average of 29% over those 2 years to 2009. And if you consider dividends in the S&P 500, the companies last year totaled $500 billion. That's $125 billion investors could be losing if we see that kind of hit this year. In fact, Goldman Sachs put out some analysis last week I saw predicting dividend cuts averaging 25% or more, and I think it could actually get a whole lot worse. And I've got a chart from Bloomberg here on forecasted dividend cuts by sector, and this really shows where the real pain might come from. Now that orange bar is the expected percentage change in dividends during the second quarter, with energy, consumer discretionary, and real estate stocks all facing major cash flow problems. Not only are a lot of those companies facing unavoidable cash flow problems and mountains of debt, but anyone taking a dime from those government bailout programs could be forced to cut their dividends for years to come. Now, researching for the video, I also came across a list on Bloomberg of dividend stocks in danger of cutting their payouts or just suspending them altogether. So I wanted to share this before getting into why REITs might hold up better. Now, a few of these shouldn't be any surprise, right? Energy stocks like Noble Energy are facing the lowest oil prices in decades, and any company in retail is about an inch away from bankruptcy. But now I don't think real estate is totally out of the woods either. Like we saw a few weeks ago in that Outlook video, there's a big difference in property types and how they're going to affect those dividends. REITs with digitally focused property as well as storage and industrial properties are actually doing pretty well. But those mall owners and retailers are just trying to stay solvent. So before we get into the numbers here, I want to send this out to the community. Which do you prefer, REITs, so real estate investment trusts, or those dividend stocks? Which do you think are going to provide the better return and the cash flow for your money? So just scroll down and let us know in the comments below. Now, of course, the big difference, though, between REITs and dividend stocks is that real estate investment trusts are required to pay out dividends if they have any taxable income. So to keep that sweet tax-exempt status on corporate profits, REITs have to pay out at least 90% of their taxable income as dividends to their investors. Now, this means as long as REITs can continue to book that income, they can't cut their dividends. They can't cut them completely anyway, like a lot of the dividend stocks have done to protect cash flow. Now, another advantage of REITs is that because leases tend to be longer term, so you get leases of 3 to 5 years and longer, the rents on commercial space are more stable compared to, say, maybe a consumer retail company that's just seen its sales evaporate over the last month or two. Now, the downside, of course, to this is that real estate can tend to lag the recovery. You get those leases gradually renewing while stocks might see a surge all at once on earnings with the rebound. Just going off the cold hard facts here, real estate has easily beaten stocks over the long term. Equity REITs in the NAREIT index posted nearly an 1,800% return over the last 30 years through 2017 versus a return of just 700% for stocks in the S&P 500. The problem over the last couple of months though, and this is why I started looking closer at those REIT property types, those different real estate property types, is that the broad funds like the Vanguard Real Estate ETF, the VNQ, have underperformed the market. Now we see the VNQ here in green with a 19% loss year to date against the S&P 500 in red and that 11% loss on the year. So this is when I started looking at those individual property types and the non-traded Streetwise REIT in my portfolio. Those of you in the nation will remember we looked at the Streetwise fund last year, a private fund that holds office space in non-gateway markets. Now since the fund invests in those non-gateway markets or areas just outside the main urban core, office demand really hasn't been hit that hard as we've seen in those larger cities. Also, since it's a closed fund, the net asset value doesn't jump around with redemptions like you'd get with those other REITs, those publicly traded REITs. And actually that disadvantage of a lockup period on the investment is turned into an advantage now because managers are able to guide the holdings through the chaos that we're seeing in the market. And this is all working out to their advantage. So the Streetwise fund has been able to maintain that annualized 8% plus dividend yield since its inception. The fund owns over 400,000 square feet of Class A office space in Missouri and Indiana and has been able to keep vacancy low with those strong tenants like Wells Fargo, Panera Bread, and Allied Solutions. But even though REITs are beating those dividend stocks now, I still think you should have a kind of a balanced approach and with both of these in your portfolio. The numbers favor real estate right now, but just look back to 2009 and it's a different story. So make sure you position in both those and check out that link to the Streetwise fund in the description below. Click on the video to the right for my 2020 outlook on all 10 property types and my favorite REITs to buy right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.